always about what Abraham Lincoln said. It's up to us what we create as the future. And as we think about it, as we dream about it, what is it that we at SEBI would like to see as the future of our markets? I think we've spent many years worrying about compliance with the letter of the law. I think we are now at a place where we are mature and where the entire ecosystem has deployed their resources, their people, their technology to pretty much ensure that there is compliance with the letter of the law. I think we all as a community, as an ecosystem, now need to move to the next orbit, which is to comply with the spirit of the law. And both of them go in the same direction. They're intertwined. It's not an easy path, but if there is a future that I would like to see in the capital markets, it would be a future where the spirit of the law and the letter of the law go hand in hand. And every person in this room today has a critical role to play in that journey. Fortunately for us, we have today in our country and in our markets a large number of role models who actually represent this quality of governance, this respect for the spirit of the law, this respect for what is right and good for the investor. We have a large number of icons in our market, many companies, many financial services companies, many listed companies who are our role models. So it's not as though we have to invent this. We already know how it's done. We just have to decide to follow those role models. Personally, and many of you know that I speak to the market very frequently, I've been noticing a subtle shift in the way that listed companies, their promoters, are thinking about not just their companies, but about their lives. And as there has been a passing of the baton from first generation entrepreneurs to the next generation, I find that a number of them share their thoughts about how they want to run their companies, but more importantly, how they want to live their lives. It seems to be an emerging theme that the younger generation is now saying, first, that they already have a lot of wealth. Second, that they see that it is possible to grow that wealth in a kosher, well-governed way. But most importantly, they share that they don't want their children to see them going through the stresses that they saw their parents going through, because their parents were sometimes in the gray zone. And that, as we know, when you tread the path in the gray zone and you don't know whether the regulator or the whole ecosystem is going to find you and determine you as being in the black or in the white, when you tread the gray, there is a lot of stress, a lot of anxiety. And the new generation seems to say that they don't want to see their children see them stressed. So I have a lot of hope, I have a lot of optimism that the role models that have emerged in our country and in our markets on good governance and on respecting the spirit of the law is a trend that will get more and more traction over the years. There's another practical reason why I think this shift will happen and will accelerate faster than we imagine. There was a time when if there was wrongdoing, it was perhaps not so hard to hide it. Today, every action leaves a digital footprint somewhere. And the regulators have become smarter. They have more technology available to them to find these digital footprints. So I think there's also this realization that now the payoff, everybody, as we know, all human beings mentally make their probability charts of saying, okay, I'm doing something, what's the point? What is the probability I will get caught? I think what technology has done to our markets is that it has increased the probability of getting caught. And therefore, it's no longer worthwhile for people to take that chance, because the negative of being caught multiplied by the fairly high probability of being caught is something that practically doesn't make sense. So this is another reason, a second reason why I believe that governance standards will improve, partly because people genuinely want to do that, and partly because there is the whole practicality that it just isn't worth it anymore, because the regulator is sharp enough, the technology is sharp enough to dig out that digital footprint and to come down on wrongdoing. The third aspect of whistleblowers. I think that, there are rules around whistleblowers and how they need to be protected. And I think it's really important, because this is another aspect. While in our experience, a large number of whistleblowers usually come when it's convenient for them to come. Not when they actually see the wrongdoing, but when it's convenient, whatever may be the motivation. But I think, again, apart from the digital footprint, people realize and understand that whistleblowing today is a reality. Every single employee in their organization, in theory, can be a whistleblower. Through social media, it can reach very, very far and wide. Media, real estate is no longer limited to the pages of a newspaper. And the entire digital world can create a momentum which starts with a single whistleblower. So this is another good reason to not do the wrong thing, a good reason to not do the wrong thing. I feel that all these trends which we see are what is going to drive our markets more and more towards respecting the spirit of the law in addition to the letter of the law. And I think the markets also reward people for this. It's not just the markets as in the financial markets and the stock price. It's also the employee market. Everybody needs growth, and everybody needs good quality employees, good quality partners, good quality ecosystem to really drive their growth. And all of those markets respect you when your governance is of a high quality. So again, yet another factor of both pull and push to really create momentum towards high quality of governance, which of course starts, as far as SEBI is concerned, at the pre-IPO stage. This is where all of you have this critical role to play. I've said this very, very often, and I think that the reason I keep repeating it is because it's the cornerstone of the markets. All the numbers that were shared earlier this morning, the tremendous growth, the tremendous opportunity, the tremendous future, all rests on the trust of the investor. If we do anything that erodes this trust, the entire system can collapse. And we know, we've seen this happen, for instance, at the time of the global financial crisis and on various other occasions. It can happen really, really rapidly. So it is the responsibility of each one of us to ensure that this trust is maintained. And again, I repeat, it starts pre-IPO, which is, it starts with you. In our personal lives, we've seen a huge trend over the last 5-10 years, maybe 5-7 years. How people have moved from saying, I go to a doctor to cure an illness, to saying, I want to do preventative maintenance of my body, and how I want to focus on wellness, both of the body and the mind. That is what is a huge trend for us in our personal lives. My belief is that if I look to the future, not just what I believe it will be, but what I desire it to be, is that corporate health also moves in that direction. It's not about being caught doing something wrong and fixing it. That's like getting a disease and going to a doctor to get a surgery to repair it, but rather to focus on fitness and well-being, both in terms of the spirit of the law and the letter of the law. That's the future that at SEBI we would like to see going forward. Thank you.
I think these were very profound words of wisdom. They went much above the normal clutter that we hear about pricing or disclosures, or you talk about value systems, the DNA, the cleanliness. My grandmother used to tell me that you are the first person to know if you are doing anything wrong. And you have to draw a line that moment itself, whether you want to cross and commit that wrong or not. Because once you've done a wrong, then, and if you're not caught, then probably you get into the tendency of repeating it. And the point that you mentioned about the probability of being caught is really very high, because when I interact with the market, the two things that I think are very important for a regulator is the respect, which emanates from the quality of regulations, the quality of discussion that you have, and fear. So it's a combination of respect and fear that really elevates a regulator to the kind of level that you have brought it. And I'm very, very proud that I've known you for so many years and I've upheld all your commitments and your mission. And you've been so kind to AIBI. You've been demanding, but that's part of life. Mahavir has been complaining a lot. Your business will grow. Don't worry. You have a good team. But thanks for the commitment that you've shown to AIBI and the grand level that you've brought it to. So I'll just limit to a few questions that I thought will be of interest to this audience. I'll not talk of numbers. We've had enough of them this morning, but the numbers have been mind-boggling. I mean, I remember when I started Prime Database, a 50 crore IPO used to be called a mega IPO. And then it went to 100 crores, and then 500 crores. Now 1,000 crores is also not a mega IPO. Now we are talking of 5,000 crores or 10,000 crores. So I think the quantum leap that we have seen, the growth of the market, size of the market, deal size, the kind of businesses that are coming to the market is absolutely unimaginable. And this is possible only with regulatory oversight and regulatory control. Because if you we have seen in the, the vanishing company scam, there was a lot of freedom, but there was no regulatory control. And therefore, I think a combination of that, I think, has been the bedrock of what we have seen in the last 3-4 years, especially, because I think the jump has been not incremental, it has been humongous. And as Mahavir mentioned, I think we are going to see much larger growth in the IPO market, QIPs, rights, all forms of offering, and maybe some new instruments that will come up with. of getting more household money into the market. So coming to a question which is of great concern, and I hear so much about it, is the pricing. I know that regulator keeps their hands off the pricing, that because you are focused more on disclosures that should enable a person to discover the price in a sense. But I am sure you have a role right now which you are playing in ensuring that pricing does not go overboard. That's the feedback I get. So what's your take on pricing vis-a-vis SEBI?
You know, I have said this, as you've said very often, that we believe in the markets. So for us to believe that we know better than the markets is just wrong. And in any case, you know, the Act of Parliament that set up SEBI said that you are not to have a role in pricing. That is why CCI was replaced with SEBI. So, to my mind, I think the test that all of us put to every IPO document that comes is that if we were the investor and we were reading the document, particularly the section on pricing, is there enough information there which will help us to assess whether this is a good price or a not so good price? So, to us, that is the test. There is no other test of saying, is this the right price? No. Is there enough information for me to make up my mind as an investor whether this is the right price or not? And I think it is in that context that, you know, even the regulation that we brought on non-profit making companies and the KPI disclosures that are required. Very happy to share that the working group that is working on that, and there are actually two working groups working on that, one at AIBI and one, you know, the Industry Standards Forum. I think there is an appreciation of the fact that it's not about trying to minimize disclosure, maximize disclosures. It's really about, is there enough? If you were an investor, can you put your hand on your heart and say, there's enough information here for me to make up my mind? So we continue with that philosophy, and therefore, you know, you would see that even in our observations and our observation letters, that for us, it's really about, is there enough for me to make up my mind? And that extends after the IPO as well, in terms of, you know, whether it is you know, approval, the resolutions that come to the AGM or the approvals that have to go to audit committee. Our logic is, are you giving enough information to the audit committee or to the investors for them to make up their mind on whether they should support a resolution or not? So it's a very consistent thought from pricing to approvals and actually running the company.
So one thing which emerged from Prime Database, Pranav actually started compiling the KPIs as they were being disclosed in the prospectus from day one. And as he told me, we have 138 prospectuses which had KPIs. And I looked at them, and sometimes what I find is that whether it is about KPIs or even about pricing parameters, for example, why should the fact that the offer price is 222 times the face value, or that the shares were acquired at 0.8 paisa by the promoters, be the bold statements in the issue ad? Because those actually are either ignored by the investors because they know that price to the promoter who has put in seed money and acquired shares and then there were bonus issues, etc. is low, or the fact that face value has no relevance. Actually, we are looking at the offer price. So face value, we are one of the few countries in the world which have face value. So even in the case of KPIs, I see the danger that we may go into over disclosures, which may, so can there be 5, 7, 8 KPIs, which are, it's difficult.
आपके हाथ में है, आप चेयर कर रहे हैं वर्किंग ग्रुप, आप लाइए recommendations, हम देखते हैं.
Because if we can focus both on pricing and on KPIs, on such parameters, that will make the promoters both uneasy as well as confident, and investors also try to compare them with other peer
See,
group?
the thing is, we are like a doctor in a hospital. So we see ill patients all the time. Right? And this is something that I always say that in all our working groups and our advisory committees, obviously we have people who come from very well-governed entities. And we keep telling them that, you can't even imagine what kind of diseases we see in the doctor's chambers, because to you, unimaginable that somebody can even do something like that. So we very often have to share in confidence, obviously on a no-name basis, the kind of egregious things that we see as a doctor. And tell them that, boss, ऐसे भी होता है. मतलब, they can't imagine, as last evening, at some 8 o'clock in the evening or 7 o'clock in the evening, this is a discussion we were having with a industry standards forum, that they were shocked at the kind of things that we narrated to them. So, आप लाइए recommendations हम देखेंगे.
Let's move on to, and we talked about this last time also, and I think a lot of work has been done at SEBI, and we have discussed the point that capital market is substantially also about timing. It's also substantially about timing. I mean, when a company plans an IPO, it has a specific roadmap, timelines, and one of the important constituents of this roadmap is the time it takes for a merchant banker to prepare an offer document, which is a humongous time-consuming process, and then the second process of SEBI giving its observations. Now, while investment bankers are getting equipped to, prepare the offer documents faster, I'm sure SEBI is working on doing them faster. And this brings me to a grave point here is about how AI is being used by SEBI. So would you like to speak something about that?
Yes, I think there are 2 or 3 things happening. First of all, there's a bunch of stuff that's already happened. So I think I've shared those numbers in public quite often, that we now measure from date of first application and not from date of receipt of all information, and that we rarely have any application going beyond 3 months, which, again, I've said this number of places, that globally, my counterparts, when I visit in ISCO, they can't believe it. They just can't believe it. That in 3 months, end to end, you return the document with a yes or no and with the observation letter. This is a benchmark that almost they laughed and said, please don't tell our companies that this is what you do. So this is...
That's a great step.
Yeah. The second thing is that we want this, and this has been driven by exactly this recognition, having been a merchant banker myself, that when the market is right, that's when you want to enter the market, and delay can be very, very expensive for the issuer. So Mr. Rao has been, I must say, extremely proactive, not only in ensuring, because it's not easy. When you get a flood of, IPO documents, how do you suddenly expand your capacity to be able to handle it? You're equipped for, 7 IPO documents in a month and you get 20. Now, how do you still maintain that it happens within 3 months, end to end? So, Mr. Rao, I must say, has been extremely proactive in terms of the way that he's managing his team to actually do that. And I must also tell you that when you say the use of AI, Mr. Rao, when a file lands on his table now, for him to approve, he uses AI himself. We have an in-house tool. And he tells me that the time that a file stays on his table has drastically reduced, because he simply goes, uses the tool, asks the 5, 10, 15 questions that he needs to from that AI tool. It's an in-house tool that has been built. And he says the quality of his file has improved, his observations that he makes on that file have improved, and it sits on his table for a much shorter time. So that's AI in action for you. I think the other thing, 2 other things that we are doing, that there is a working group, again under Mr. Rao's leadership, that's working on demystification of the IPO document. So I had announced this earlier. We are now at a very advanced stage. Is that right, Mr. Rao? We are at a very advanced stage where there will be a standard template of an IPO, and you simply fill it up. It's like a fill in the blanks. It makes your job as a merchant banker and as an issuer much easier. And anything which doesn't fit into that normal template, there is a provision for exception reporting. And that way what happens is the document itself can now be seen and read in two parts, that this is standard, this is exceptional. So the focus for the officer dealing with the file also is that I'm going to focus on what is exceptional because the standard is anyway standard. So we hope through this process to actually shorten the time both for you to prepare the document and for us to process the document. Because if your projection comes true, aapke muh mein ghee shakkar, if we have 1,000 IPOs over the next 2 years, there's going to be a lot of work at SEBI. So hopefully, this is another initiative which will greatly help both you and us. The last thing is, and I've saved this for the last because it's my favorite in terms of AI. So we are developing, and we've already developed, it's just come out of the oven, so it's not full-fledged in use, but we're starting to use it with very good effect. It's actually processing the document itself. Use of AI to process. Now, we're very fortunate because in our market, everything is public, right? The document itself is in public domain, so we can use the publicly available AI tools. We don't have to build our own specialized tool for it. And what that tool is doing is threefold. The first is it analyzes the document against of standard expectations that a document should have A, B, and C. So it scans the document and says, does it have A, B, and C? And then it replies saying yes, no, and the page number on which it is. So the officer now knows, okay, these 50 things I don't need to read, a 400-page document. I already know default that it's there. He can just refer to those pages to verify. The second thing that it does, and this is the most fun stuff, and we call it what's missing in the document. So the AI tool goes and scans the entire internet, social media, everything. And it identifies that is there any reference to the company or its subsidiary or its promoters or its KMPs or its directors, and is there any news item about them? It then collects those new items and through another set of, and this is, now we know it's called agentic AI. We didn't know when we made it that this is what is called agentic AI. It then uses that information to classify that and say, is there anything out of this which is negative and therefore a red flag? And it reports it to the officer saying, check whether this has been disclosed in the document or not. So if, let's say, a pharma company had a huge problem with a regulator somewhere, and they've not put it in the document, we now know that you had a problem and you've not put it in the document. This last step, this much we have done. Now the last step is the third agentic AI part of it, which is that it will automatically read the document, tally it with those red flags and check whether you've reported it or not. Right now an officer is doing it. So, as I said, intuitively we have learned to use AI internally. And then, by the way, just to make our life easier, in every bureaucracy, in every government office, there's something called a green note which gets generated, which is what is the file that goes to the ED for approval. The green note gets automatically generated. That also we have finished doing. So, we hope that with this entire automation and the use of AI, not only will we improve the quality of our examination of the document, but we will be able to do it faster. And then we'll have tech-savvy bosses who will also use it and add their own layers, to that whole learning process of AI. So, God willing, 1,000 in the next 2 years may be possible, and I assure you, we will be ready. Question is whether you will be ready.
So, merchant bankers, beware. AI is in full force at SEBI. And, I've been looking at prospectuses since the 70s. And I found that disclosure is basically a battle between what an issuer is willing to disclose and what a regulator is capable of extracting. And it becomes, therefore, some kind of a negotiating this thing. But use of technology, use of better resources would minimize this. And I would like to, I don't have the support, I have not discussed this with the AIBI, but I had proposed this long ago that cases of wrong, willful disclosures should lead to black points for the merchant banker. If there is a deliberate attempt to misinform, so there is an issue of underinformation, there is an issue of completely wiping out a piece of information, and there is a case of misinformation, deliberate hiding of data in a manner or presenting something like a classic case where a person was not an MBA and was disclosed as an MBA. This is a class example, but wrong information. And I think that fear of earning black points or red points or whatever you want to call them should also make the lawyers and the investment bankers more accountable and more responsible in what they bring to SEBI.
Actually, sir, mere zamane mein, when I was an investment banker, SEBI used to have these black marks and brown points. And I keep telling my team, we were frightened like hell. I mean, if we were to, we would look at the document 50 times and say we can't run the risk of collecting a black point. But it was disbanded, and despite my urging, Mr. Rao has stoically refused to bring it back. Who is not ready? AIBI is not ready.
Okay, we'll bring a discussion paper on this and we'll take your guidance on to take it forward, because I think that fear of deliberate misinformation is a crime. I mean, if I'm trying to fool the investors at large by deliberating putting a piece of information which is not correct, which is supposed to misguide the investors, then I think I'm guilty of a big disclosure offense and necessary action should be taken.
अगले साल का तैयारी हो गया.
Okay. I'll move to another very area of discussion, and which is about issue objects. I know, I can see from your smile how difficult an area it is. Because while there are businesses who say that we don't have plant, we don't have machinery, we don't have projects, we cannot define, issue objects. There are businesses which require all this money for working capital or for repayment of loans or whatever it is. And therefore it is, although SEBI has been considering giving GCPs and you are allowed to raise money, but I see a lot of companies struggling with how to go public with objects of the issue which are not rejected by SEBI. That is a big fear. कि हम honest company है, अच्छी company है, we want to raise money for X, Y, Z, but the reasons I want to give would not be enough or sufficient for SEBI to approve my issue objects.
So I think that my answer is broken into two parts. Since we have always said that the reason for existence of SEBI is capital formation, I think there can be no dispute that if a company needs money, it should have an easy and convenient way to raise it. At the same time, how do you say to the investor that give me 300 crores, I will not tell you what I'm going to use it for. It's all for general corporate purposes. By the way, I may send it to my subsidiary abroad in a jurisdiction where even an audit of accounts is not required. And then that company can be free to do whatever it wants with that money. Since there is no object clause, there is no monitoring of the end use, because you gave me full freedom, you gave me a blank check, kahin bhi dal dein paisa. You want freedom to say, I'll do anything I want with it, just trust me. I think it's hard.
No.
I think it's hard, but we have a solution. See, when we say that we are aligned with the objective, we just don't like this path of saying, give me money, give me a blank check, I can do anything with it. Then it's our responsibility to suggest an alternate path. So, our suggestion and solution is that raise the money that you need, for which you know what you want it for. When you need money again, we have given you this rights combined with preferential allotment, which takes end to end 26 days. अब आपको ऐसी कोई जरूरत होनी नहीं चाहिए जिसमें you can't wait 26 days to get the money. So our solution is, please pick up money whenever you need it. And we've made it so easy, 26 days. And this, there's no conditionality also, right? Earlier, our fast track rights issue, only certain companies were eligible. What we have now done is everybody is welcome. So what is it you want to do that you can't wait 26 days? आप बताएं.
For the QIP.
Rights come preferential allotment. It takes 26 days end to end. So you please come whenever you need the money, pick up the money from the market. But why do you need to say, allow me to, you give me a blank check and I have no accountability or responsibility to tell you what I need to do with the money?
So,
ये तो venture capitalists भी blank check नहीं देते हैं.
I agree with you. So I think this is a subject which probably needs much more debate and discussion. But my suggestion would be to develop a negative list of what you cannot use IPO proceeds for. So for example, you cannot give a loan to the promoter, you cannot invest in...
Sir, हाथी के दांत खाने के और दिखाने के और होते हैं. As I said, we are the doctor in the hospital. We have seen such egregious misuse of IPO money. And it all goes back to related party transactions, layered transactions, particularly with overseas subsidiaries, you know, the claim of, and all of this usually goes into purchase of things which will not have, you know, any tangible evidence. You know, we bought software, we bought a company, we did this, we did that. So come to us, we'll show you all the egregious behavior. That's why we have industry standards forum. That's why we have consultation. That is why we have advisory committees. So when you see on an anonymous basis all of what we see, then it's like that. It's like saying कि भैया roadside पे monsoon में कम से कम पानी पूरी मत खाओ. बाकी टाइम खा लो, लेकिन monsoon के टाइम अगर आप पानी पूरी खाओगे तो फिर jaundice वगैरह तो होगा ही.
Yeah, so we'll take this further, but one subject that you've been speaking about, and AIB has also done a lot of work in the recent times, is the SME platform, SMEs. Now we have seen the numbers growing rapidly, we have seen the amounts being raised also rise, and what is most amazing is the times these IPOs get oversubscribed. You know, the numbers are again mind-boggling. And yet we have found many SEBI orders and many SEBI concerns about various aspects of, because SEBI does not approve the offer document or look at the offer document. So to that extent, you know, you are depending upon the market integrity to come up with the right kind of IPOs. What are the key one or two things that you'd like to, you know, there are a lot of SME issuers probably would be coming to the market. 2 or 3 things that they should be on the lookout for or should be careful about when they are planning an IPO. And what are your concerns about the SME IPO as of today? The SME IPOs are actually mega IPOs once upon a time. You know, 50 crore, 100 crores is an SME IPO these days. And they attract lakhs of investors.
The reason I'm hesitating is that I don't need to tell this audience what to do. They know. They know when they're bringing a pump and dump company into the market. They're knowledgeable. They've been in the market so long. जो आदमी इस तरह की कंपनी ला रहा है कि मतलब 3 साल पहले कंपनी बनी, इतना सा टर्नओवर था, अब अचानक इतना टर्नओवर हो गया है. Can't they see that this has a high likelihood of being accommodation entries to pump up the volume of transactions? Can't they see that there is no staff there? Can't they see that they've not even visited the office even once? Can't they see that the commission... The fees that they are being given is for what purpose? I don't need to tell you that. In fact, you need to tell us that. So I will not pretend or presume that I know more than this audience. So ये spirit of the law वाली बात है. आपको पता है, if you are bringing a bad company into the market for doing pump and dump, और वही stock split करिए, preferential allotment करिए, फिर वो bonus issue करिए, फिर वो इतना पैसा दे दीजिए merchant banker को, वो cartel के साथ आके liquidity तो थोड़ी सी होती है. So from 7 rupees you take it to 500 rupees within 3 months. Every day it's hitting upper circuit. आपको नहीं पता है क्या? मैं क्या बताऊंगी आपको? आप ही को पता है. So इसमें मेरा कुछ बोलना, मैं तो यही कहूंगी कि आपको पता है, if you're bringing a bad company to the market, you should not bring it. It's as simple as that, Haldia Sahab.
It's easier said than done. I know where you're coming from, and the gyan that you gave in the, in your presentation, I wish everybody adopted that. But we know that there are bad companies, there are bad merchant bankers, and the chances of not being caught, that you brought out very well. And I think SME IPOs, my only advice or the way forward would be that don't call them SME IPOs. They are IPOs which are depending upon investors' trust. And go to the market with the same kind of disclosure, diligence as you would do for a main board. Just because SEBI is not looking at the offer document does not mean that you can get away with whatever you want to do. Okay, 2 small questions. One is, it's a big question, but I don't think we have the time to debate it. It's about corporate governance. And we've been struggling with the institution of independent directors for a long time. There has been some improvement, but as my data keeps showing, we need, I don't know, whether it's regulatory steps or industry standards or nudging by SEBI or the fear of law catching up. But how do we ensure that corporate governance is actually in practice? Because we know that people are not, there are few limited, I'm not saying all companies are guilty of it, but majority of companies would find the easier way out because there's competition, there's a need to grow, there's a need to make money, or there's an opportunity, and therefore corporate governance, because the board is substantially managed by the promoters still. We don't see the level of due diligence or governance at the board level. Are there any...
I'm actually quite optimistic. See, is there wrongdoing? Of course there is, right? Otherwise you wouldn't need a regulator, you wouldn't need regulations. But are we on a path where governance is steadily improving? I think so. I think that there is a far higher level of awareness amongst independent directors, particularly I would say the larger companies who have, now in spirit independent directors, not just in letter independent directors. I think that move is there. I think that, as I said earlier in my address, that I think the promoters themselves want to have clean companies. And so I'm actually quite optimistic. I think that over the next few years, we will see quite a dramatic change in the way in which the companies govern themselves. And the ones who don't are the ones who are really intent on fraud, and therefore our job as a regulator to isolate them and not allow them to contaminate our market is a role that we'll have to play. But I would say that I am really quite optimistic that our governance standards have improved a lot over the years, over the last 10, 15 years, and that over the next 2 to 3 years I would expect to see much more acceleration of good quality of governance. I'm very optimistic.
So I'll just leave this subject with 2 observations. One is that we continue to find that the reasons of resignations continue to be vague.
Sorry.
The reasons for resignations,
Reasons for?
resignations by
Resignation.
independent directors continue to be vague. Number two, there is, as I suggested earlier, if an independent director resigns from a firm before his term, that's actually a red alert. And if we can find some mechanism of, because we have not found any of these people going to the media or to
But
the
I
shareholders.
thought we now have that. Is that right, Mr. Rao? It's part of the mandatory disclosures? Yeah. No? I thought we've already done that. Reasons for resignation.
Yeah, but they are not giving the real reason. If there is a board problem, if I'm not happy with the company, there's some fraud going on, I'll resign. But I'll not tell the regulator or the
again,
media.
Mr. Haldia, I would point out there are I don't want to take names here, but certainly right now I can think of at least half a dozen companies where when the independent directors resigned, they gave 3-4 page long letters to say why they are resigning. And there was no doubt in anyone's mind that they were resigning because they felt that governance was very weak. I'm saying this didn't happen 10 years ago. So if even half a dozen companies and boards have this today, I think we're on the right track. So it will happen. At the end of the day, I think it's partly due to, as I said, that they are genuinely independent. More and more, we're seeing more and more boards having genuinely independent people. And the second thing is, a growing understanding that you are liable if you have not protested on something that you have seen happening before your eyes in the board, then you are also liable and responsible. That growing realization is also there. So I'm again very optimistic. I can think of 6 cases where in the last 10, 12 months people have come out openly and said.
I'm only hoping this number of 6 or 10 goes to 50 or 100 out of a few thousand independent directors who resign and cite no reason.
But
because when I talk to these people, ma'am,
we should be pessimistic.
When I'm
we are seeing an upward trend.
Because I know a lot of these people who resign and I call them up. अरे आज मेरे पास प्रणव ने alert भेजा है, you resigned. Before your term क्या हो गया? And then they will tell the story. And I said, why didn't you report it? How can we go against the promoter?
The market also reads the signals. ऐसा भी नहीं है कि सब कुछ बताना पड़ता है. Market also reads the signal. If an auditor steps down or a respected independent director steps down, people read the tea leaves also. ऐसा नहीं है.
The last question is on proxy firms. Where do you see them going forward, especially in relation to mid-cap and small-cap companies which are so under-researched, and yet there's so much of money moving into those companies. So is there...
So we think that we think they play a really, really important role. The reason we believe that they are very, very effective is because it is subscriber pay model and not the issuer pay model. So therefore it leads to the question that beyond the top companies which are researched from a proxy advisor perspective because people are willing to pay for their reports, the question comes down to who will pay for it. So this has been debated quite a lot. Then at some stage it is said, should that money come from the investor protection fund, etc., etc. Then the question is, then how will you choose kisko dein? Then you say, acha, abhi to there are 2 or 3 big players. Then if tomorrow, if it is a then suddenly there will be a patronage system which will happen that, is SEBI going to now say, okay, you do 50 companies, you do 50. So there are, ye bahut pechida mamla hai, but it all boils down to who is willing to pay. So if we can come up with a solution to who is willing to pay, I'm sure they have no reservation in doing the work. They would love to do it.
So Mahavir, I think it's a good area for us to work on. Because I think there's a need to put out more research and more data and more analysis of a large number of these firms. Because a lot of them are also going to be gold mines, going forward. They are, good companies in the making and will become large.
But I think you'll see some very good work. You know that one of the areas where the proxy advisors worry the most, and in line with also the regulator worrying the most, is in related party transactions. So the two big proxy advisors are now on the verge of launching. I may be stealing their thunder a little bit here, but they are on the verge of launching RPT portal, which will basically give a lot of detailed information on related party transactions of various companies. And I think that that will be a very, very valuable resource for any analyst, any investors, anybody looking to judge the governance of a company. So I'm very, very pleased they've collaborated, they worked together, they've done it all free of cost, and we should have a lot more democratization of the data on RPT, related party transactions coming from them.
Great. So I think we'll conclude with that. We've overshot our time. I just conclude by saying...
One last thing I thought maybe I would share with you is, you know, since the audience here is the people who are really that bridge from pre-IPO to IPO. So I just thought I would share with you that we are actively considering when listed trading. That period, today we are at T+3 from closure of the issue to listing. But even during those 3 days, there is a lot of effectively what in my days we used to call curb trading. Aajkal pata nahi kya bolte hain usko. And so we feel that if anyway investors want to do that, why not give them that opportunity in a proper regulated way? So when listed, trading of when listed securities is something that we are actively looking at with both the exchanges, and hopefully we will bring that to you. Even as you bridge the pre-IPO to IPO period, we will partner with you with that new product. Thank you.
Thank you very much. Thank you again for accepting our invitation to be the chief guest today. Thank you also for providing the platform to the association and to the market as a whole, because the ultimate proof is in the pudding, and we've seen the markets grow. So you may have any kind of regulations, any kind of oversight, but in case the markets don't grow, they mean nothing. So I think what you have demonstrated personally is your zeal, your mission, your commitment to bring about a better marketplace, a robust, safer marketplace. And as we keep discussing at AIBI, although they as merchant bankers often feel that they are being frustrated in some areas or there are issues in some other areas, I think the overall sense is that we have a progressive looking regime. And we wish you all the best, and we hope to continue to interact with you in the future. Thank you so much.
Thank you so much, Madam Chairperson, and thank you so much, Prithviji Haldiaji. Thank you so much. Ladies and gentlemen, we'll now be taking a tea break, requesting everyone to please adhere to the time and be back. We start with the first panel discussion post the tea break, so requesting you all to please be there on time. Thank you so much.
Secondly, adopting grounds-up approach, AIBI has launched a 6-month full-time course called Certification Program in Merchant Banking in association with NASM. AIBI recognizes the need to promote investor interest and takes several measures in that regard from time to time. Some of the recent initiatives of AIBI for promoting investor awareness and education includes the launch of an investor section AIBI website, walk-through animated video titles No IPO Investing. As a thought leader in the industry, AIBI publishes research papers and works on numerous thought leadership initiatives. The Securities and Exchange Board of India, SEBI, has entrusted AIBI with statutory functions and roles, recognizing AIBI's expertise and commitment backed by objectivity and transparency. Join us in shaping the future of Indian capital market. AIBI, creating a robust investment culture.
Certified, Category 1 SEBI registered, qualified registrar, and transfer agent, a name synonymous with trust, resilience, and unparalleled service. For 13 of the past 19 years, we have been the #1 in handling IPOs on the main board, a testament to our commitment to excellence. Our core services, fortified by a strong risk mitigation framework, enhanced due diligence, and leading technology, has enabled companies to raise funds, service investors, and fulfill compliance requirements. We serve 1,600 listed and more than 22,500 unlisted corporates with a combined base of more than 12 crore investors. Our registered office, powered by renewable energy, is located at the Green LEED certified, gold-rated building, 247 Embassy Park, Mumbai, and spans a sprawling 80,000 square feet. We also have branches in strategic locations across India with a workforce of 800 plus registry professionals.
And beyond registry, we have in our suite investor relations, under our brand name Orient Capital, where we serve large number of flagship clients within India and across the globe. Under the banner DF King, we provide proxy advisory services,
augmented offerings including Tracken, a surveillance tool to monitor insider trading, Empower, ESOP advisory and administration services, and MeetAZ, a comprehensive end-to-end board meeting management solution. We are continuously investing in traditional and futuristic technologies like ML, cloud telephony, conversational AI, and RPA for enhancing the client experience. From our humble beginnings, we have evolved into a powerhouse, reaching out across India and making a real impact where it counts. We are now a part of the MUFG Corporate Markets and a division of MUFG Pension and Market Services. Mitsubishi UFJ Trust and Banking Corporation. The Trust Bank, the 7th largest bank in the world, is a consolidated subsidiary of Mitsubishi UFJ Financial Group, which is one of the world's leading financial groups. With over 360 years of history and total assets of approximately $3 trillion, it is headquartered in Tokyo. MUFG is present across the globe in approximately 2,000 locations in more than 40 countries. The group has about 120,000 employees and offers services including commercial banking, trust banking, securities, credit cards, consumer finance, asset management, and leasing. MUFG's shares trade on the Tokyo, Nagoya, and New York stock exchanges. This change brings a paradigm shift, aligning us with one of the largest financial groups in the world. We are set to redefine how financial services operate, with a focus on innovation, sustainability, and unparalleled client service.
With a new ownership structure comes a fresh identity. We're excited to share that our brand is transitioning to MUFG Intime. As we move forward, our vision remains clear: to continue leading the industry through innovation, sustainability, and service excellence. We aren't just a company, but a trusted partner in your growth.
Thank you for being part of our journey. Stay connected, stay secure, and trust the business partner that has been serving you for over 3.5 decades.
Systematix is a diversified financial services company with over 30 years of domain expertise. Headquartered in Mumbai, we have strong presence across India in Delhi, Kolkata, Jaipur, Indore. With over 250 plus professionals, we operate in business verticals like investment banking, institutional equities, wealth management, equity capital markets, HNI and retail broking, portfolio management services, and asset management. We have 30 plus analysts covering 200 plus companies across sectors like FMCG, banking, and railways, which has been showcased in multiple media outlets. We stand out as an active and admired investment banking firm for mid-market corporates with transactions executed in private equity, mergers and acquisitions, and public markets. We work with leading family offices providing equity advisory, bonds, portfolio management, and estate planning services for clients like Apar Industries, Shree Cement, Berger Paints, Technocraft Industries, and others, managing a total AUM of rupees 1,000 crores. Systematix leadership has demonstrated strong execution capabilities with 100 plus years of combined experience.
A lot goes behind orchestrating a successful capital market communications campaign. It takes an ensemble to deliver precision. Intense research and narrative creation leads the way. We meticulously polish your brand to showcase a compelling equity story, cultivating public opinion and driving investor confidence. Adfactors Capital Market Communications Group executes high-stakes, complex mandates across the corporate lifecycle. The capital market journey with Adfactors unfolds like a classic sonata, before settling into a steady investor relations cadence. Whenever called upon, we are prepared to deliver on mission-critical projects. Seasoned by multiple market cycles, we've earned the trust of India Inc.
In a world where markets are constantly evolving, one organization stands at the forefront of India's capital formation landscape. Welcome to the Association of Investment Bankers of India, AIBI, the apex body of investment bankers in India. AIBI is committed to creating a robust investment culture. AIBI plays a pivotal role in shaping India's financial ecosystem. Unveiling of AIBI mascot, AIBI Chanakya, aimed at creating robust investment culture. Through our initiatives, we provide a platform for investment bankers to connect, learn, and grow. Recently, AIBI has taken several key initiatives to promote knowledge sharing, innovation, best practices, and overall capacity building in investment banking. Revamped due diligence manual to enhance industry practices. Manual of standard observations on offer documents, compendium of AIBI advisories. One of the major challenge faced by industry is manpower crunch, especially when Indian capital market leads on top and expected to further scale up significantly. Adopting grounds-up approach, AIBI has launched a 6-month full-time course called Certification Program in Merchant Banking in association with NASM. AIBI recognizes the need to promote investor interest and takes several measures in that regard from time to time. Some of the recent initiatives of AIBI for promoting investor awareness and education includes the launch of an investor section AIBI website, walk-through animated video titles No IPO Investing. As a thought leader in the industry, AIBI publishes research papers and works on numerous thought leadership initiatives. The Securities and Exchange Board of India, SEBI, has entrusted AIBI with statutory functions and roles, recognizing AIBI's expertise and commitment backed by objectivity and transparency. Join us in shaping the future of Indian capital market. AIBI, creating a robust investment culture.
Intime today stands as an ISO 27001-2022 certified Category 1 SEBI registered, qualified registrar, and transfer agent. A name synonymous with trust, resilience, and unparalleled service. For 13 of the past 19 years, we have been the #1 in handling IPOs on the main board, a testament to our commitment to excellence. Our core service.
Ladies and gentlemen, we're about to start.
Risk mitigation.
May I request everyone to please start returning back to the hall. We're about to start. We now start our first panel discussion for this afternoon.
22,500 unlisted corporate.
To all the people standing in the corridors, may I please request you all to please join us. We present a panel discussion on the rise of unicorns from startup to stock market success. And may I please invite on stage our moderator for this session, Mr. Abhijit Vaidya. Joining us on this panel discussion, we have with us Mr. Rahul Bothra, CFO Swiggy, Ms. Richa Chaudhary, Partner Trilegal, Mr. Gopal Jain, Managing Partner Gaza Capital. And of course, we heartily welcome our session moderator, Mr. Abhijit Vaidya, MD Kotak Investment Banking, to join us on the stage. Welcome, ladies and gentlemen. All right, ladies and gentlemen, we're about to start this panel discussion. May I please request everyone standing near the entrance to please join us. Ladies and gentlemen, all the people standing near the entrance to please settle down. We're about to start this session.
Good afternoon, everyone. May I request all the guests to take their seats, please? Okay, we'll start in just 1 or 2 minutes. Request all guests to settle in quickly, please. We have some important discussions to conclude in time. Thank you. Good afternoon, everyone. It's my pleasant duty here to introduce the panel, and before that, I just wanted to say that the topic cannot be more relevant for this conference than this one. the year 2024 really saw a slew of IPOs from unicorns, new age tech companies. And if it wasn't enough, year 2025 is going to be even more promising. I think we saw last year about 8 to 10 IPOs from unicorn and new age tech companies, but we are promising start with over 25 IPOs from new age tech companies this year. And I am in a very safe company today. I have a lawyer, Richa. She's a very experienced person, handholds many companies for the capital market transactions, decades of experience with her. We have a provider of capital and a very matured investor, Gopal. Know him for many, many years. Deals with investment and their investee companies in a very matured manner. So, welcome Gopal. And really the showstopper for whom we are all here, Rahul Bothra, CFO of Swiggy, the most successful IPO, if I can say, for 2024. The first successfully completed, confidentially filed document and successfully delivered IPO. I think he has been the real supporter, real hero, if I can say, to deliver this IPO over 2.5 decades of experience in the industry. I think I'm really delighted to have this panel, and I think I'll just kickstart the discussions with the permission of the panel. I think I just want to request Rahul first of all, because our topic is rise of unicorns from startups to stock market success. So I would like request Rahul to kind of share his journey as an entrepreneur, as a CFO, how it has been in an unlisted space from a startup to a unicorn, and then we will get into the other area of stock market success. Over to you, Rahul.
Sure. Hey, thanks Abhijit for the introduction. Just a quick backstory. I worked in India for the first decade of my career, and then I moved abroad. And I was watching from the sidelines. This was the years 2009 to 15, when probably the first unicorn in India had born. That was year of 2011. And from 2011 to 2017, in a period of 6 years, there were only 10 unicorns, and we were fortunate to have been born during that period. So we were among the first 10 unicorn batch, if you were to speak. We just completed a decade of our existence, last year, and really fortunate to have been born during that era where there was a lot of financial capital available to young startup ideas who were looking to build in India for India. So before that, before this cohort of this batch of startups, I think most of the businesses or startups or the IT industry was more export oriented. If you look at the services side, we were probably one of the first companies to attempt building a product for consumers in India on the services side. And kind of looking back, it's been really tough journey. So if I were to break my entire journey into 4 parts, the first one is really around the product market fit that we were able to get with our first service that we introduced, which was democratizing your food delivery experience. Why should India only get your pizza in 30 minutes? And why can't it be the entire cuisine? And all of us are so different. There are just so many choices that were available. So for us to be able to establish this whole 30-minute delivery network, bringing technology at the forefront was something that really got us product market fit. I think what differentiated probably many startups from that time, and we were probably the 15th food delivery startup, but what differentiated was us using technology and also proving what we call the business market fit, because it's just not enough that if you can demonstrate the product market fit, but the business market fit around what are the value pools of economics, and ultimately, consumers may delay the monetization, as is the case in many, companies in India, but it won't be delayed. It won't be denied to you, right? It may be delayed, but not denied. And that is something which we have experienced over time, as consumers got hooked into the convenience bandwagon. I think the next probably, part of this whole startup journey has been the trials and tribulations of surviving through patches. And if you kind of look at our 10-year journey, there were probably 3 economic cycles that we went past. From, raising, private rounds of dollar. When I first raised a $1 billion private round, I thought I had kind of done it and achieved everything, right? And the kind of investments that were required to build the franchise, to build, the consumer connection meant that we actually had to raise another $1 billion round in the private setup. So, and during COVID, when the business went down by 80%, and probably all of us had maybe 6 to 9 months of cash flow from that, run rate of, expenditure that we were doing, and the investments that we were doing, meant that there were various cycles of just being, I think solvent enough to be able to fight the long battle and then come out on the winning side. All right. So that's the second part. I think the third one is really around the financing. I think as young startups, when we are still solving through the business market fit equation, it's important to not be leveraged. I think we have seen some examples in the Indian context where growth stage companies, when they do end up taking leverage, when it's not really clear on the operating cash flow side. So taking these high, probably leverage decisions of only, raising equity really helped us and keep us in good stead, because we didn't have a single rupee to return to anybody during our journey, and only took the risk capital. And, once the risk capital, obviously the payoffs are higher, but so is the risk-taking ability of the investors. The fourth part of really the journey has been what we now call the institutionalizing what was built, which is the public market journey. And something which, we take real pride in, that, having built the company with the right governance systems over the years, we always knew that public market was our, one of the, milestones to our destination. And something that we've achieved is really about institutionalizing what we have built. So yeah, it's been a decade, fun building what we have, but the most exciting opportunity still lies ahead of us, right? It's almost say the foundation has been built and the edifice on top is to be built from here on.
Great. I think you really explained your journey really well. I think the startups, they are I think the leaders in dreaming big and making it happen. But all dreams can come true only with the financing. And we have, I'll just request Gopal to throw some light on how do they look at the journey of these startups to unicorn and listing as from private equity investors' perspective and general investors' perspective. If you can explain your perspective, please.
Sure, Abhijit. I've been investing in stock markets for nearly now 40 years. And over the last 40 years, there's been a profound shift in the identity of a company that's been going public. When I was a little kid, I learned my investing from my mother. And, my mother had a very standard formula. She used to invest in IPOs, and she would only pick multinational companies that were going public. So there was a time Hyundai is not the first multinational which is going public. There was a time when multinationals in India used to go public because the government forced them to go public and share a piece of their equity with the investing public. And then came a time when conglomerates became popular, so on and so forth, to a point today. And I think 2024 will be remembered as a seminal year for 2 reasons. One is that I think from an investor perspective, venture capital and private equity as an ecosystem has emerged as a preferred supplier of companies to the IPO markets. And, we'll dwell on this later. And on the venture capital private equity side, I think 2024 will be remembered as the year in which using IPOs to exit companies has become mainstream for the industry. So, if you look at the data, last 5 years data from venture capital and private equity, there have been more exits for venture capital and private equity in India in the last 5 years than in the 15 years prior to this. So for both sides, which is investors that invest in companies prior to them going public, namely venture capital and private equity, and investors who invest in companies after they go public, which is the investing public and investing institutions, there seems to be coming together. Venture capital and private equity has become a preferred supplier for a variety of reasons, replacing earlier suppliers like multinational conglomerates, etc. And for venture capital and private equity, which so far used to think in terms of M&A, etc., these markets are far shallower. Many global firms actually, have started using IPO markets to even exit companies where they own majority positions. So it's been a coming of age for this venture capital and private equity ecosystem, both as a supplier and from an investor perspective.
Okay, great. I think, Richa, over to you now in terms of, we talked about regulations in the earlier session. We have a disclosure-based regime, but more for our new age tech companies, startups, when they go public, you have any perspective to share from a lens of a council when you help them, both in unlisted form as well as when they are going listed. So would you have any points to share with us?
Yeah, sure. Thank you. So, a couple of points which we thought maybe we should address and, eventually think of finding a balance from the time that the investors are investing in the startup to the time that they go for an IPO. Now, we all know that IPO is probably the most preferred exit right now, and therefore it's essential to find a balance that the rights the investor gets while investing in a company. We see these shareholders agreements during that.
Just keep it closer.
During the DRHP stage, which have to be amended, and most of the rights need to get waived or dropped. I think let's maybe look at some of these rights which may cause or create a problem during the IPO process. One of the most important rights, one of the most common rights that we've seen that investors have is a joint right to, say, appoint a director, basically having a joint right. Now, what happens is SEBI views it as, persons acting in concert, because if somebody if two separate sets of investors have rights together, it's viewed as persons acting in concert. That generally then has to be either segregated during the time of the IPO or sometimes even dropped. So that is actually one of the most pain points we've seen with investors not liking it. The others are promoter identification. Generally because of such a large pool of investors, you don't really have one person who holds a large amount of shareholding. That eventually ends up making the investor sometimes a promoter or a group of investors because they have common rights together, promoter. So these nuance points also should be, I believe, looked at the time of investment when the company is investing in the startup. Then there are those minor points on, say IPO costs. We will see one clause to say all the costs will be borne by the company. Now that's not allowed under law anymore. So these kind of cleanups, maybe it's time to now do right at the time of private equity investments. I think broadly, yeah.
Sure, I do see the point that you're trying to make about, founders actually are driving the company. They should continue to get ESOPs. I think that's an important point from a startup ecosystem, new age economy. I think, Rahul, I just would like to again come back to you. While you broadly described your journey over the years, but I think people are really curious to learn more about your journey during the IPO process. And quickly thereafter, I would request Gopal to also throw in his thoughts. How does he actually kind of, see his portfolio companies get ready for IPO, and when he actually pushes them, now you must go public. So I think both of you can just jointly take this next question.
Yeah, sure. So I think the journey of the IPO, does not just begin when the merchant bankers are appointed. I think while some of us in the room may think that, but really for a company to establish that, hey, IPO is one of the milestones in, say, the long journey that we are going to set out for, there are various choices that are, start coming through, right? And one of the choices that, say, we experienced, say, 3-4 years ago when we were first discussing about, what's the domicile of us, listing, there were enough and more voices in the room suggesting that India listing for a tech company or a consumer tech company will never be understood because the markets here only look at, a track record of profitability, the understanding of the technology evolution, the flywheel effect that you get with certain platforms building, etc. The market is not deep enough for investors to understand. I think, and we obviously were listening to all these voices and, we started in India. We did not have even a foreign bank office and we never thought the need to actually start thinking about externalizing any structure. So it kind of became, even more apparent to us that, hey, if we don't even have a structure to consider, let's get more data points to understand how, deep and wide is the Indian market to understand, companies like ours. So one data point that we got was when one of our peers in US got listed called DoorDash, we actually went through, some of the investor lists that had invested in a company like, DoorDash. Again, when they came to the markets, they were not profitable, etc. And when we did the overall, analysis of this investor role, we saw that 17 out of 20 top investors of DoorDash in their IPO had a direct investment office in India. Right? So this whole notion of saying, a lot of investors stay away, they are not, investing in India, they don't even have a, a desk, is something that gave us a lot more confidence, saying if the pool of investor and the capital is similar, and it will only get wider over time, because India, while we may, see, and some of our peers who got listed before us demonstrated that whole India premium because of the growth factor that continues to, get. So I think now it's kind of probably very easy to, for most companies are reverse flipping, coming back to India, but this wasn't so apparent when the decision itself was being made. I think the other part, I think during the morning, the speakers talked about this whole governance piece, right? And something that is very, very close to at least my heart and, our company's heart. This whole appointing of independent directors, getting the governance structure, etc. in place. This is a thing that you don't do, when you are just, getting your papers ready for filing. So we invested in an independent board, at least around 8 to 10 quarters ahead of us, even filing. I think when you get this, a lot of independent directors who are, missionaries and visionaries in their respective fields, you get a lot of outside-in perspective, and you're able to build the company with the right kind of governance structures. The other bit is around transparency. I think, again, we have heard about, startups in India not having enough of, say, the governance layers or the transparency layers. Even in the private space, I know in the listed universe, we do a quarterly, investor call. In the private space, I used to run a monthly CFO call with our list of investors, right? And we had a pretty long list of investors having raised the capital that we did. So there were this 40 plus investors with the analyst team who would attend a monthly CFO call, which I used to host and to tell them about how the market, etc. is evolving. I think you start building the foundational layers of what a great company should be, say 5-10 years out. When you look at other examples within the Indian ecosystem, you almost want to start building it, ahead of time, and not just as a tick, a tick in the box required for you to get into the listed universe. So I think lots of such, preparations that really went into before we started the listing journey. I think towards, the last year, there was again, as we were preparing for listing, there were some hiccups during the journey. Again, some of the large listings had very tepid, openings, and that kind of changed the sentiment a little bit. But I think just being true to the story, us being able to communicate to the markets, getting the right institutional interest to also show them the medium to long-term, path to profitability as well as the growth trajectory of the business has helped in really good stead.
So Gopal, would you like to add from the investor's perspective, when do you really push your portfolio company to go public? And what are the characteristics that you see that a company is actually ready for taking the public money?
So this year will mark the 30th anniversary of my first private investment. So 30 years ago, I invested in Division 18. I have been taking companies public for a very long time. And the framework for preparation has evolved over time. And currently we use a framework we call the 3G framework, which is growth, governance, and ESG. So let's say 30 years ago, it was all about growth. Then it became growth and governance. And now it's about growth, governance, and ESG. And I'll tell you very soon another G is going to be added. But let's demystify this. So when we say growth, it's about predictability and sustainability. Public markets are, I'm speaking to the choir here. All of you are practitioners in public markets. The way we prepare for our companies is that their growth should be predictable and sustainable. Governance. The typical company we invest in doesn't even have its board meetings properly. So first, the second is content of board meetings, but governance goes beyond board meetings, right? Governance is something that has to permeate the whole length and breadth of a company. And ESG, I know it's become a fancy word. Sometimes it becomes a fancy word. Sometimes it becomes a hated word. But you know, until 100 years ago, people used to believe that companies run only for shareholders. Then people started believing companies run for shareholders and employees. Shareholders, employees, and consumers. Shareholders, employees, consumers, and society. And now it's the planet. And the new age consumer uses a very important lens. The new age investor uses a very important lens, which is how friendly is this company to each and every constituency. This framework of G, G, and G, the three Gs, growth, governance, and ESG, is how we prepare companies. And the fourth G that's going to be added very quickly is technology, right? So India is one of the few major markets in the world where a cement company can still go public. This is going to change. The profile of the market's going to change. The profile of market cap will change. Then another filter we use, not everybody should go public. Not everybody can go public. Only 1 in 10 startups get funded. But of the startups that get funded, only 1 in 50 or 1 in 100 will make it to an IPO. So, you know, so it's not like everybody's birthright to go public. Another very important filter we use is leadership or sizzle. So leadership or story. And we ask companies, you need to have either scale/leadership, or you need to have a differentiated story. So we use this term scale and sizzle. So either you need to have leadership, which is scale, or you need to have a differentiated story. And the best stories are both scale and sizzle. So two different frameworks, one for preparing a company, and the other two is how we operate the gate. That if you have to pass through the scale and sizzle gate.
Yeah. Richard, just one quickly. I think you talked about use of proceeds earlier. You want to just touch upon that area, which is again a sort of a pain point. Though we have a kind of a industry neutral kind of a regulatory framework, but this is a pain point that I think you would like to talk about, right?
Yeah, sure. So yeah, objects I think is probably one of the most hot topics right now, and considering the topic we are discussing, you know, unicorns and startups, I think the one object that differentiates and we see most commonly for these companies is because of the kind of business that they are in. They spend a lot of money in marketing. And more often than not, these companies will have an object where they want to utilize the funds for marketing. Now, just to substantiate that, first of all, you know, we have this one criteria which says that, you know, there is a limit on the percentage of money that can be utilized for marketing unless it can be substantiated. Now, the substantiation is subjective. We all know that. What backups to get, what to really look at. How do you know that I gave an ad on Instagram and that got me, say, X number of customers? It becomes difficult to do that. So somewhere, you know, trying to find that balance, you know, there are options where you go ahead and get, say, a report from a third party. But even that, the validity and the impact of those with the regulator still yet to be seen. I think that is one object that probably differentiates them from all the other objects that is generally there for, you know, all sectors of the company. There's another point which I would also like to talk about for, you know, companies of this sector, which is, you know, the KPI, the peer comparison that we include in the document. I think because of the nuanced sector and because the sector is evolving and it's new, there are very few comparable companies that are there in the market. So what we are seeing is, and why I'm saying is because it is linked to objects, I'll just get into that in a little bit. What we're seeing is increasingly is that there will be one company with one segment of their peer which they have disclosed as a comparable, and the numbers that are being compared is probably with all segments of that company. So then the market that you're showing for that particular product, which is just one segment as compared to 5 other segments of the company, it may not be accurate. And then you go back and link that to objects, saying that, hey, listen, this is the market and this is how much I would like to raise. That becomes a little bit of challenge, and I think, you know, we've seen issues come up on that. I mean, I don't think anybody has a real solution except that, you know, time will probably help us get more issuers and more peers in that sector. But yeah, this is one very major issue that I at least personally see in this sector.
Great. Just a last question for both Rahul and Gopal. Now that you're listed, it's all balle balle, stock is doing well. Now from here on, how do you see the life changing, and what are the expectations or any thoughts that you would like to share? And as from the investor standpoint, Gopal, how investors can be disciplined and how they can work together with the issuers. Any thoughts on that? I think I'll first request Rahul and then Gopal in that order.
I mean, I have to say that life's a lot more structured since we are listed. As I said, with all the multiple private investors on our cap table and, this monthly governance, etc., that we were used to run, the amount of time that we used to, spend on, say, non-business areas tended to be really high. And with the listed, I think listing this has really helped in terms of structuring your overall, say, number of investor, meetings, your analyst calls, and a lot more time back into the business. So that's one thing that's really changed. I think as I talked about the tenets of whole governance and transparency, there are, I think, various things to be done there. I think overall we are learning from the ecosystem a lot. There are peer companies, who we learn a lot from, and we want to build with the right tenets and start building it, from ground up. So that's how we are approaching, the listed space.
Investors have a huge responsibility at the time that companies go public. Typically investors will stay on the board for not more than 12 to 18 months. And the question is then, what do they do in these 12 to 18 months? And I want to give you a backstory. While I was preparing for this panel, I decided to Google the list of top IPOs 20 years ago, 2004. I would encourage each one of you to do that, and you will be amazed to see what I saw. I wasn't surprised. I knew what I was looking for. Just as 90% of startups die within the first 4 to 5 years, 60% of companies are no longer, listed companies are no longer relevant by the 20th anniversary of their listing. And 90% of listed companies are no longer relevant by the 40th year of their anniversary. And I've seen this because I was investing when the Sensex was born. And if you look at the constituents of the Sensex. So remember this, that companies don't have an appetite because of the Pareto principle for more than 200 or 300 companies. And there can be companies who go public who are not part of the top 200, 300, but they have to find a way to the 200 to 300. This is the role that investors play. The most important gift a departing investor can give to a company is a strong board. And because that board does two things. One, we've spoken about sustainability, which is how can you be a sustainable business? How can you be relevant 10 years from now or 15 years from now? But even more important, perhaps, at the time a company goes public, it makes a number of promises, implicit promises, explicit promises. And it's the board's role to ensure that management delivers on those promises. For some, it could be a path to profitability. For some, it could be things they said they will not do or things they say they will do. This is the role of a board. And this is the biggest mistake that companies make. And then two things happen to them. Either they fade into irrelevance or again private equity buys them 10 years. The reason why private equity as an industry was born, it's an American product, was born in the US, is because public markets also spin out a number of derelicts, companies who no longer are relevant, who have financial value, but that value is not reflected in their listed price. So every few years, some companies will go private. The biggest gift that departing investors can give to a company is a board that can ensure, or can at least try and ensure, that founders, deliver on their promises and work towards sustainability.
Great. I think we just ran out of our time, but I'd just like to conclude that it was great working with you, Rahul, on your successful IPO. You've been a fantastic entrepreneur, I would say, more than a CFO. Gopal, you've been a great investor and great guide for all of us, and of course, Richa always keeps a close eye on all of us. And I cannot end this session without thanking the fourth partner in our IPO journey, which is the regulators, both SEBI, BSE, NSE. They have been doing a fabulous job. all the hard work that we all put in. I think there is a what we say is a perfect running between the wickets in cricket. So that's what I would say we see as a practitioners. And I must thank on behalf of Kotak, on behalf of our association, and from every one of us to the regulators for their heartwarming support for all the work that we do. I think with that, we'll have time for one or two questions from the audience, if there are any. Okay, I think we'll close the session. Is there a
Check. Yes. Thank you so much, ladies and gentlemen. Can we have a huge round of applause? We now may request Sachin Chandiwal to come forward to offer a token of appreciation to Mr. Rahul Bothra and Mr. Abhijit Vaidya. I would request Lakha Nair to offer a token of appreciation to Ms. Richa Chaudhary and Mr. Gopal Jain. I would also like to request the CEO of AIBI, Dr. Milind Dalvi, to offer a token of appreciation to Ms. Richa Chaudhary and Mr. Gopal Jain. She's here. Sir, you also go, na? I've taken your name. May I request the claps to please keep going on? We had a fantastic panel discussion on the rise of unicorns, from startups to stock market success. Moderated by Abhijit Vaidya, and our speakers, Mr. Rahul Bothra, Ms. Richa Chaudhary, and Mr. Gopal Jain. Our panelists being felicitated by Sachin Chandiwal, Lakha Nair, and Dr. Milind Dalvi. Thank you so much, gentlemen. Thank you so much, ma'am. Thank you. May I request the applause to please keep going. Thank you. We now move on, ladies and gentlemen, to our next panel discussion, Lessons from SME IPOs, the key takeaways. May I please welcome our moderator for this session, Mr. Alok Harlalka, MD, Gretex Corporate Services. Our speakers and presenters on this panel, Ms. Kamala, CRO BSc, Mr. Manas Chadda, MD, Lighthouse Canton, and Mr. Ankit Sharma, CRO NSE. Welcoming our panelists and our moderator for this session, ladies and gentlemen, post this discussion, we will be breaking for lunch. Request you all to adhere to the time as we have a host of other discussions and speakers to present post lunch. May I request our moderator, Mr. Alok Harlalka, to do the honors. Thank you.
Good afternoon, everyone. Let me welcome Ms. Kamala, CRO of BSc Limited. I'm also welcoming Mr. Ankit Sharma, CRO of NSC. I'm also welcoming Mr. Manas Chadda, the fund manager. Friends, it's my pleasure today I am representing Gretex Corporate Services Limited, Category 1 Merchant Banker. It's my privilege that today I have got an opportunity to speak about the lessons from SME IPO's key takeaways. See, being a merchant banker, we need to understand that which kind of SME we should select. Though we have done more than 49 companies listing in SME platform, so we have understood that what kind of quality company we should look at. So I have identified some of the few points as a merchant banker that which kind of company we should select for an IPO. So few of them I have identified. One is that when we select and when we see any company, when we meet any promoter, we have seen that they have their family-run businesses and they do many of the RPT transaction. I think many of the merchant bankers must be here. They understand RPT transaction. So before selecting the company for an IPO, I hope that RPT transaction must be looked at. So sometimes we have seen that because of RPT transaction, sometimes IPO gets stuck. So that's, I think, more important point from the merchant banker to understand before selecting the company. Point number two, that many of the promoters or the management, when they want to list their company, generally they don't have the control in terms of compliances part. They know how to do their business. But according to us, when we go for list any company, we see many irregularities in the compliances part, where sometimes company gets stuck for some non-compliances. So I think that's second point, that as a merchant banker is the duty to understand the compliances part, whether it has been done in a prominent way or not before selecting the company for an IPO. And point number three, that when any company wants to list, so at least after the listing, 50 to 100% growth, I think it has to be there for SME companies in terms of their top line and bottom line. And fourth number point, which I have seen that sometime company has a huge potential to grow, but after listing, they are unable to handle the growth of the company. So I think these four parameters, according to us, according to our experience, that merchant bankers should see before selecting the company for public. So, ma'am, question to you, that what would be some guidelines that you would give to the merchant banker so that they can understand the level of the due diligence to be conducted on a client company? What do you think on this part, ma'am?
Good afternoon to everyone. At the outset, thank you very much for having me on the panel. SME is the hot subject of the capital market environment as of today, as you would know.
Yeah.
See, as you mentioned, Mr. Alok, people are bubbling with ideas. They are looking for capital, and SME platform is one place where capital formation can significantly happen. And people who are toying with the idea, wanting to take the idea to market, are experts in the thought that they are going through, but they are not very familiar with asks when you come and list on a listed platform like BSE and NSE. So I think merchant banker combined with the council are the mentors, philosophers and guide to take the company through the end-to-end life cycle and also make the company aware of the responsibilities. So we have seen, last decade has seen number of SME companies going up, especially last 1 year. Like we have seen the growth, we also have seen some not so desirable practices, naturally as a consequence, because exchanges and SEBI are mandated and are required by design and default to protect the interest of investors. If something is going wrong, obviously we'll try to fix it. You would have seen December 18th board meeting of SEBI, they have come out with a new guidelines for SME listing. I would urge all merchant bankers to familiarize themselves with that. And more importantly, I also want to say that when in doubt, please reach out to exchanges. We are there to service everyone, whether you are an issuer company, whether you are a merchant banker. If you have any doubts, you can always reach out to us. In fact, we also conduct many awareness programs to take all these companies through the requirements and the rationale for the requirements, etc. So I think exchanges are accessible, reachable, and at your doorstep to offer whatever clarification, whatever guidance that is required from exchange. So do not depend on, many people out of fear go to all third parties for their opinion, but you don't need to fear. Please reach out to exchanges directly for any doubts that you may have. This is an open offer from both the exchanges side. So I would urge all people, if you are in doubt, don't go and pay money for getting your consultation. Please come to our doorstep and make use of the facility.
Good thought. Thank you so much, ma'am. Thank you. I think this is a good thing that you have highlighted, that it's easier to communicate with exchange rather than going to consultant and understand the issues. Thank you so much, ma'am. So, Ankit sir, the question to you that we feel that increasing coordination between the exchange and merchant banker, I think, is quite important as on today. So, I think merchant bankers need to, what additional measures would you suggest to achieve the same for the merchant banker and exchange both?
Good afternoon, everyone, and thanks to AIBI for inviting us for this convention. That's a very interesting question. I think Madam had answered part of it in her thing. One is the coordination between exchanges and the merchant bankers is a continuous process. So I look at two types of coordination. The first coordination is between individual merchant banker and the exchange team on issue-to-issue basis. The second one, which we have started now since last year, we are having half-yearly dialogues with AIBI and its members. Not only for SME IPOs, but for main board IPOs also. So we share our experiences of the half year that has gone by. We also discuss some contentious issues. It's a closed-door meeting. We also discuss some contentious issues which the merchant bankers have raised in the past and try to find a solution. I had requested Dr. Dalvi that apart from this, we should have some sort of a training platform for merchant bankers as far as, and this is especially in context of SME merchant bankers, as far as documents preparation is concerned, due diligence is concerned, and ongoing compliances are concerned. So we feel that there are some new players who may not be as experienced as the others are, and they need some hand-holding, where I would request AIBI to do that. And it was wonderful to see the SME guidance note coming out today. I think that is the way to go, the way to get the merchant bankers involved. Look, at the end of the day, your big ticket merchant bankers, the established ones, they have been in the market for the last 30 years. They know the rules, they know the regulatory thought process. But it's time that the AIBI leadership also takes active interest in development of the merchant bankers who have joined recently. And as ma'am mentioned, our doors are always open. Even if you don't have our mobile numbers, our email IDs are there in public domain. Just drop a mail and I'll ensure that if I am not able to meet anyone or talk to anyone, someone from my team will do that.
Thank you so much, Ankit sir. So, question to Manas sir. Being an investor, I think you had a very good experience, I guess, being an investor. So, could you suggest measures to improve quality of company getting listed?
Hi, good afternoon, everyone. First of all, thank you for having me on the platform. As ma'am rightly said, I think, Alok, you put me on the hot seat. I think SME is the hottest topic. When I told my company that this is something that I need to present, and Lighthouse being a large and a niche venture debt and venture equity investor, I think the question which is flooded on my LinkedIn the day the announcement of panel was, because I think the kind of companies, and the journey that people have seen specifically to emerging SME platform, I think is extraordinary in terms of reward. But before I take you through the measures, I think, Alok, the critical part, I think, is for us is to understand what has been our journey. So few numbers that I want to place. I think last 4 years, I think SME exchange itself has seen a phenomenal growth. From a average issue size of 12 to 13 odd crores in 2021, today average ticket size is close to 42 crores, which constitutes to a 3x kind of a growth on IPO issuance. If you look at from a market capitalization perspective, from a 52 crore market capitalization, we are today at close to 175 odd crores of market capitalization post-listing. So the journey has been phenomenal in terms of both absolute number. I am not going categorically in terms of number of issuance, because again, people pick up what they want to pick up, right? But I think this says a lot, both in terms of exchange, I think the efforts that they have put in, I think regulator, I think recent step that ma'am was saying that SEBI has put in specifically in terms of bringing new IPOs. I think I really loved the end use requirement where the promoter is not allowed to use money to pay off the loans, repay related party transaction, capping of OFS. And to name some, I think these are very, very critical steps to build a lot of confidence. I think Gopal was there on the earlier panel, and they were both discussing their journeys on private market. I think SME exchange gives that platform, right, what globally people have done on private markets. I think what we have used this as a platform is that for us, it's as simple as that. I look at SME as private market investments with liquidity. And the beautiful part is that these are profitable companies. Now, I think mayors, coming back to the relevant questions, I think SEBI has done enough, I think, to build the confidence, but I think we don't need to look at anywhere else. Let's look at the main board, right, which is the right, correct set of peer. I think 2-3 suggestions that I would love if that can be introduced. One, I think as an investor, I want to know my company as quick as possible. So I think from a 6 months financial reporting, if we can also do a 3 months a quarterly review, I think that will add a lot of confidence in terms of investor appetite, and you will see a lot of mutual fund participation, because that is what people know. People want to know the information. Secondly, I think a lot of media hype and a lot of news articles that I've seen specifically talking about number of times IPO has been issued. I think people are talking larger sum of money getting issued on SME exchange. That's absolutely right debate to have. But I think as capping of upper limit, I think no, as ma'am was saying, the chairperson for SEBI was saying that nobody should take advantage of lacuna, right? So I think if capping of IPO in terms of issue size on SMEs capped, right, is important, I think minimum issue size is also critical in SME IPO. Because I think that will restrict a lot of companies to avail public money, right, if they are not a particular size. So I think both sides, if that can be done, I think again it will bring a lot of transparency and a lot of good companies would come in. And lastly, I think like main board IPOs where credit monitoring authority is being appointed for a minimum 100 crore issuance, I think for SME, for as an investor, for us critical is end use. So if that size can come down to 50 odd crores, is that? Oh, I think that's again, I think it's a very good step. Is it announced?
December 18th, press release is announced.
Okay, I think that's what I would say. Thank you.
Thank you so much, Manaji. Thank you so much. Ankit sir, question to you that what would be your suggestion to merchant bankers to improve the issued documents for minimum exchange queries?
This is a subject.
Exchange queries.
This is a subject which is quite close to me.
Yeah.
So as our MD Ashish Bhai mentioned in the morning that out of the 250 documents filed during this financial year, 78 were withdrawn or returned on account of lack of proper documentation. And that is where I mentioned in my earlier answer, the role of AIBI becomes very necessary. More than that, so first of all, for all the bankers who are helping the SMEs to reach out the market, please read the AIBI guidance note, go through that. The answer, a long answer to that question is covered in that note itself. What is the regulatory expectation from IPO? Your document reflects the kind of due diligence that you have done on the company. So I get surprised when I see a promoter who is 15-year-old has done MCom. I am surprised when there is a CFO who does not have a formal qualification. That bothers us, that disturbs us. There is no proper object justification. We discussed when Madam had discussed with Mr. Haldia also. Objects are not properly defined in the document. The end use is not defined. The fund utilization is not done, is not laid out properly. And the information given to investor is minimum. And that is why you will see sometimes the addendum for an SME IPO runs into more than 150 pages. You are being economical with the disclosures at the time of filing, which leads to queries, further queries, and then we ask you to file the addendum or the corrigendum. If the merchant banker is more than upfront in disclosing everything, doing proper diligence, seeking relevant questions from the promoter and the management, then I don't see any reason why the number of queries should rise. I don't want to differentiate between the merchant bankers over here, but even in the SME world, there are some where the quality of documentation is really very good. There are others who need to work a bit harder to come up to the expected regulatory levels.
Thank you. Thank you so much. Kamala ma'am, a question for you. See, we have, as we are from in same industry, I mean from merchant banking industry, we have seen sometime that the query when merchant banking gets from exchange, sometime definitely merchant banker responded to the query, right? But sometime we think that exchange don't get the clarity or the right answer pertaining to your query. So what kind of suggestion you supposed to give to the merchant banker that when they get query, how they can give the right answer of the question what you raise from the merchant banker? Sometimes there's a gap. They don't understand what you are asking and they're submitting the document, but exchange don't get the right answer. Then again, flow of queries going on. So what do you think on this part? Yes, ma'am.
So, very interesting question. Before even I answer that, I will top up what Ankit was talking about. What are some of the issues that worries exchanges when they are looking into the documentation? See, basically in the last 6 months, we have found, SME, large number of companies are coming for the platform listing. Because of outliers and a few wrong practices, the entire segment is getting painted with a black color. So we need to come out clean. I would urge AIBI to take the lead in demystifying the SME listing piece. And I also think that merchant banking community for SME has grown in last 2 to 3 years. AIBI can play a very, very effective role in training all the newcomers in the merchant banking side. Exchanges would be happy to partner in the training so that we work towards first time right kind of documents. Now, when documents come, we look at not only the checklist point, we look at the spirit as well. See, many times merchant bankers argue, where is it mentioned in your checklist? But we go by spirit of the law as well. As I already told in the earlier response, protection of investors' interest is paramount for us. So, based on wrong disclosures, based on various, conspicuous English language, if contents are there, definitely we'll be asking you more questions. Because if we don't understand, we 100% are sure that investors will not understand. So, if you want a quick turnaround for your documentation, the simplest ask is simplify the documentation, don't jargonize the documents. And last 6 months, if we look at the concern areas that have emerged in SME segment, it is on the object for which funds are raised and the purpose for which the funds are going to be deployed. See, in some of the cases, what we had found was the entire proceed was to be routed to a subsidiary company and, many other further activities were to be done. And exchanges genuinely believed that merchant bankers would have done due diligence on all the major deployments that were proposed. But when issues got highlighted, when we started scrutinizing more closely, we found that what was stated in the document was far from truth, and there were issues of contention. So those issues we had to go back and ask queries. So all this, when you write in a codified language which common people cannot understand, and also when, there are issues raised on the third parties for whom you are deploying the funds, then definitely there will be series of questions that will follow. So now that the new reforms have already been announced in December 18 circular, hopefully all that will be things of past and we'll be cleaning up the ecosystem. So that should pave way for quicker clearance of SME application. Nevertheless, despite having notified everything, there could always be 101st thing that can come up. Our simple suggestion to you is, if merchant banker is in doubt, he can always come and meet up the exchange officials to get a perspective of what they are thinking. Lot of things get clarified during meetings, but that doesn't mean that everything will be informal. During meeting, it is meeting of minds. Exchanges will tell what they are looking for, you will tell what you are going to represent. All of that we would want in the written documentation form so that we can disseminate to investors at large. There is no private information that exchange will hold on to. Whatever information comes to exchange has to be disseminated. So all of you please don't be under a myth that if we go and meet and talk to exchanges on informal basis, they will give approval. That is a myth. Everything has to be backed up by documentation. We have learned, securities market has been in existence for long. As you know, BSE is celebrating 150th year. Like you all are evolving now, we have seen evolution of securities market over a long period of time. We know what is the right sense and what is the wrong sense. So looking at the document, if we are raising query, please don't argue. XYZ issue, you clear, why you are not clearing? You have some other interest in this. Those are all myths. We are looking for transparent disclosure of information. We are also looking at dissemination of information to all investors at the same level, so that level playing field is there. I can't say that only for some select investors I will disclose extra information and I will not disclose for common investors. Those are things of 80s and I don't think it will hold good anymore. So my sincere advice to merchant bankers is, please protect the reputation of SME segment by your responsible due diligence on the entities that are seeking to list on SME platform. And when things go wrong, that is the time to transform and take our segment to the next level so that we all uphold. And, you know, India as a country is looking forward to many entrepreneurs coming and knocking for capital formation. We should make it a good case study rather than becoming international center for bad case studies. And as I already said, majority are good companies. Because of handful of few bad companies, we are getting painted black. So it is time for us to come clean and also showcase what Indian capital market can contribute to growth of economy by encouraging entrepreneurship.
I think very good point, ma'am. You have highlighted that the roles of the merchant banker, which you have said. I think you are absolutely correct. So, last question to Manas sir. What is the suggestion according to you for the investors? What's suggestion you want to give to the investors, being a institutional investor?
I think more than suggestions, I can tell you that what processes we follow, right, in terms of selecting companies, in terms of when we look at investments. And I think as everybody on the podium been consistently saying that this is one platform, everybody wants to do well. But there's a lot of, I would say, a lot of red signals. A lot of people are watching this because phenomenally, obviously, one is that the background in terms of exchange doesn't have past experience as compared to main boards. But the growth rate that India is currently at, I think SME exchange itself has done a phenomenal job in last 4 years when we saw. And let me be very honest, I come from a venture equity background. One fund itself is 50% of startup market, and that slowdown, I think, when a lot of large, very, I would say, not large, but I would say mid-sized company came to us and they were profitable. I think we told them that I think this is one exchange that you can look at entering rather than going for a private equity round, which was down, right? Everybody knows last 2 years in terms of fund flow. So I think my suggestion, or I would say the processes that you follow for any investment should be true for SME or any mid-cap, small-cap, where a lot of research is not available. For us, first criteria, right, as ma'am was categorically saying, I think key role here is to understand the management, right? Unlike a large cap where a lot of research is already available, these companies are very, very small, right? There's hardly any research. So for us, key area of investing into a portfolio company or SME or a mid-cap has to be that we have to appoint our own legal as well as financial due diligence. Because for me, the main path here is understanding of fund usage. Because as ma'am rightly said, a lot of companies I would have seen have raised money for capital, for working capital requirement, which is a big red signal for us. I would rather fund a company, high growth company, which is taking money for capital fundraise rather than using money for